What's up, guys? Brand new day. I'm back on the streets in Florida, grabbing a monster. I'm heading in the gym. All right, guys, just finished at the gym. I was checking out my buddy Judd's new Hummer. How much horsepower is it?
1,000 horsepower. 10,000 pounds, 1,000 horsepower, air suspension. It's just a beast.
Yeah, dude, it's awesome.
It's a beast.
It's nice.
You can borrow it anytime you want, bro.
Yeah.
Take it for a cruise.
Put it on the channel. All right, guys, heading back to the truck. I was just talking with him. So what he does is he trades puts and covered calls. He does the wheel strategy. I know a lot of guys have left comments on the channel saying, dude, you got to get into the wheel strategy. He was explaining it to me. He was telling me the same thing. He's like, you got to get into this, man. He says he does really well with it. So maybe it's something I need to learn. I'm pretty elementary with my investing style. I'm gonna eat this steak.
Yes.
Guys, getting out the Uber, going to get the E30. All right, we're back in the E30. I'm outside. I'm cooking burgers and bratwursts. All right, guys, it's a brand new day. About to hop in the 911. I'm gonna go to the gym. Then I'm gonna go work. It is a hot Florida morning. Holy hell. Like 110 degrees, it feels like. I gotta get the tire pump. I gotta pump up the tire in the 911. Told you we're like the Beverly Hillbillies out here. But it is toasty. I'm gonna start this thing up, so I'll let it warm up for a second. Been sitting for a little while. Let's hope it starts. Brand new day, we're out in the 911. It's nice and toasty outside. I got it in sport mode. Oh, I haven't had the turbos in a little while. I don't want to floor it because I don't want to freaking spill my drink everywhere. Man, so I saw some articles, you know, Warren Buffett, he has the most cash on hand right now than he's ever had in history. And everybody's saying like he's predicting a market crash. He may be, but you know, I think something else happens when he has all that cash. I was thinking about it. So every single time he's had all that cash, it's always been right before a market downturn, whether like a big correction or a crash. But I don't think it's so much that he's like stockpiling cash. I mean, he has been a net seller of stocks, for sure, for like I think the past 9 consecutive quarters. But I think what happens is he just can't find anything to buy. So it's like a catch-22. Like, it's like, yeah, he has a stockpile of cash because he can't find anything to buy, and he can't find anything to buy because everything's kind of frothy. So eventually, yeah, the market crashes a little while after that. I think that's more of what it is. Not like he's trying to time the market, more like he's waiting for the perfect pitch to take a swing. But people forget too, like I've listened to a lot of Berkshire Hathaway YouTube video, like his meetings, and he's talked about in the past, like if he had $1 million, he could easily get a 50% return annually by buying undervalued companies. Because he was a student of Benjamin Graham. If you guys don't know who Benjamin Graham is, he wrote The Intelligent Investor. Well, I think he was a professor at Columbia University where Buffett went. I'm pretty sure, I could be wrong about that. But Buffett was into him first, his value investing strategies, and then he actually went and like learned underneath him. He was like his professor. But what I'm getting at is Buffett, he has a large, massive amount of money, you know, hundreds of billions of dollars that he has to deploy. He can only buy up to a certain percentage of each company. You know, he can't be like controlling a lot of these companies unless he buys them completely, like he did like Geico or See's Candy or Dairy Queen or something like that. But those are inside of Berkshire Hathaway. They have a very unique structure because they can basically, it'd be like me getting dividends from it'd be like me having like 20 e-commerce businesses all under the same umbrella. And if one of them makes profits and I don't have any place to put it inside that business, I could say, oh, we could take this money and we could put it inside of this business that we own. And it's almost like he's compounding the dividends inside of his structure depending on what business he puts the money into. But the point I'm trying to make is that Buffett can't just go and deploy all this money. If he sees, like, for example, the Mag 7, the market caps of these companies are massive. Yeah, maybe there is a lot of efficiency and things that are changing with AI, and they probably are going to be even more profitable, which is crazy to think, and have even more free cash flow. But Buffett came from the value investing world. You know, when he was managing small sums of money, they were like Graham, they would try to find $1 for 50 cents. So Graham, he would use like a discounted cash flow model. So he would project the cash a business would make in the future, and he would determine what it's worth today. And if he found that it was worth way less than what it was selling for at the time based on its future cash flows, he would, and it had a margin of safety. He would do a margin of safety of 20%. So let's say, for example, he found that a stock was selling 20% below its intrinsic value, he'd feel comfortable buying it. And he said if you did that over time, you'd have satisfactory results. That's what he said. Man, this house is for sale. I wonder how much that is. I love buying, you know, I buy like a cross section of America. Like I choose SCHD because I like to watch the dividend income build. But you can buy anything. You can buy VOO, you can buy VGT, you can buy whatever sector it is that you like the most. Or just a broad diversification of sector across all the sectors, like, you know, the S&P 500. But the other strategy I've always liked is the Benjamin Graham, old school Buffett value investing style. And if you guys aren't familiar with what that is, the shortest, quickest, check out these palm trees with coconuts. I'm glad to be back down here. Quickest, shortest book to listen to is Joel Greenblatt's The Magic Formula That Beats the Market. It's basically value investing for dummy method that you could use to find companies that are undervalued and also decent companies. Because sometimes if you use just the low PE ratios, like some people will look at that, or low price to book, could be buying kind of like a value trap. Something that's so cheap, and it's cheap for a reason, like maybe Bed Bath & Beyond or something. But I don't know though, Bed Bath & Beyond might still have an internet business. So a lot of people forget that when you go and you buy, I'm just explaining all this because I know a lot of you guys that are listening are just starting to invest, and I don't want to go getting all, I mean, to be honest, dude, I'm like I say sometimes, I'm a hippo with a tie on. I know enough to get myself in trouble. So half the stuff I say could be wrong, so make sure you do your own research. I'm just giving you guys are following the channel for like a year and you find out everything I've told you is just completely wrong. You're like, what the hell, dude? Why am I listening to this guy? So a lot of people forget, you know, that a stock is a share of a business. Like you're buying a portion of a business. So I'm just explaining this in layman's terms because, like I said, I may be even saying half the stuff wrong, but just give you a better example of what I'm talking about. There's 911, 996. Let's say, for example, a business is, let's say the business has 1 million shares, okay? The shares is like when you buy a stock, like a ticker symbol, and you buy one share. Let's say it has 1 million shares and they're $10 a share. That means the total value of the business is $10 million. That's called the market cap. The market cap is the total value of the business if you were to say, I'm going to buy the whole business today. Now, when you buy a share, you're buying $10 worth. But you're a shareholder. That means you're a part owner of the business. So if you buy 10, you have $100 in shares of the $10 million market cap. So that's the percentage of the business you own. Well, the market cap of NVIDIA is so high, it's massive. But the reason it's so massive is because of its growth. But just like looking for an undervalued business, people are projecting the future growth of NVIDIA to be massive. So they have projected a growth rate, a very high growth rate, way into the future. And they now have invested enough money into NVIDIA to match the future growth of what they project it's going to be. So a lot of these things are priced to perfection. They're priced for future growth, which we know NVIDIA is going to have. It's going to continue to grow. It's in a massive growth path with hyperscale data centers and AI and all that stuff. Just like you're projecting the future growth of NVIDIA and you can say, wow, look how expensive it is. You could also find like $1 for 50 cents on the ground. So the formula that Joel Greenblatt came up with to find these easily is he uses earnings yield. It's the inverse of the PE ratio. So I think it's like 1 divided by the PE ratio number times 100. But you don't need to do all that. And I'm not saying to do this. I'm not saying that, like, I'm saying just if you want to, like, listen to his book, The Magic Formula That Beats the Market. There's other formulas, guys, on YouTube. Like, one guy's from MIT, and he's back-tested, like, his strategy, which is just buying extremely low PE ratio companies without even looking at return on capital. And it's outperformed, like, over a 10-year period. It's, like, beaten everything, which is really wild. But he only holds them for a certain period of time. But I'm not saying to do this. I'm just saying that this is a strategy, something for fun. You could take a small portion of your portfolio, or you could take a fake stock account with paper stocks, like a fake one, and see like what would happen if I did do this. And I'll tell you right now, there's times when this strategy works, and there's times when it doesn't. It doesn't work as well now with like algorithms and bots and ETFs. So for example, like if every ETF, like VOO, VGT, VUG, SCHG, if like the top 10 holdings of those ETFs are all the same stocks, then when people buy them, their money's getting spread across those top 10 over and over and over across all those ETFs. So all these the top companies are just getting money pulled into them. You can still find ones that will revert to their mean. So they'll have reversion to the mean. So you'll buy something well below its intrinsic value with a margin of safety, and maybe it'll take time, but eventually it should come back to what it's really worth. Like Buffett says, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And it's based on the earnings of the company. Okay, so real quick. So let's just say you're like, I want to try Joel Greenblatt's formula. This is what I would do for fun. I just do this for fun sometimes. Go to stockanalysis.com. Just try it. Stockanalysis.com. Just Google it. Click on stock and then click on screener. Once you're in screener, you're going to see all the stocks that are in the stock market. Now, click on filter and type in the word return, or type in return on capital. It'll pop up. Click on return on capital and add that as one of your filters. And then make it to where you want a high return on capital, like over 20%. So you want to have companies with over 20%. Like Charlie Munger loved Costco because I think it was over 18% return on investment capital. Then the next filter you're going to make is earnings yield. Earnings yield is what we talked about the price of the share against the earnings per share. So you're going to take the earnings yield and you're going to do a high earnings yield. So you can do over 10%, I think it even has over 50 in the filters, but it's going to really shorten the list. Now look through those companies and just Google them. But what I like to do is I like to look those up, and then I like to take them and I like to put them in valueinvesting.io, and I like to see if it shows they're also below their intrinsic value. Two different value investing analysis. You got to look at the stories of the businesses. Like I said, you don't want to buy a value trap like a trash company, or something that might have a weird, unique model. Like for example, Cal-Maine Foods, the ticker's CALM, C-A-L-M. That's on the list of high earnings yield, high return on capital. Yes, it's a good business. They're like the #1 producer of eggs, I think. But you have to ask yourself, like, is this like a cyclical thing? Is this like, does this go up with him? What is the, like, how does this, like, why is this so high right now, the return on capital? And you remember all the news about eggs, and they were showing chickens with chains on because eggs were so expensive. So you got to just like do your due diligence as far as like what the businesses do and if they even have a future. But this is not financial advice, and please do your own homework. Like I said, I never even went to college, dude. I'm just watching YouTube videos and doing stuff on my own, listening to audiobooks, and I'm just trying to learn little things, here and there. But I'll tell you this right now, you don't need a finance degree to make money in the stock market or to do good in business. You don't need a business degree. What I've realized over time is that all the people that you assume are like the adults and the ones that have it all together and that know it all, it's not so true. I feel like there's fools all the way up the chain, all the way up the ladder. It's like everybody's faking it till they make it. Never compare yourself to somebody. Just do your own thing, and there is no right answer. So I feel like if you just get started, whether investing, whatever it is you're into, e-commerce, starting a pressure washing business, there's no right way. Just do what you do. Just stick to it. Just consistency, I think, is the key. But I'll see you guys in the next video. Let's go.
Ooh. All right. Woo. This is light work. Come on, spill the tea. Yeah. Ooh. All right. Woo. This is light work.